Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Imagine you are retired. You can do all the things that you want to do. You can travel, play with your grandkids, have the retirement of your dreams. Think about that. Why do some people live the dream they want in retirement while others just barely get by? Stick around because we're going to talk to you exactly what you need to do. You got to follow a few simple rules, and if you follow those rules, you will be successful. Good morning. Welcome to the show, everyone. Show's called Your Money, Your Wealth. My name is Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I am with the big man, of course, Mr. Alan Clopine. He'll be joining us in just a second to break things down. But when you look at retirement, there is some golden rules that you have to follow to make sure that you're successful, right? It's not investing in gold, but you want to make sure that you follow some simple rules. That's the financial focus today. You know, when you take a look at retiring, you know, people will say, all right, well, here, I'm confident that I want to do all sorts of different things. But only 38% are confident that they can afford the extras, the trips, the vacations, the spoiling of grandkids. But 72% say their dream of retirement includes doing all these things. There is a huge disconnect when it comes to what people really want to achieve and what they can achieve. And I think the reason for that is there's no plan in place and they're not following some simple rules when it comes to their overall finance. Let's bring in the big man to help us out to break it down. Alan, I really want to do all this stuff, but I really can't do any of it. Yeah. I mean, that's the problem, isn't it?
That's
when
the
it comes to
reality.
retirement, it's like, hey, I have all these grandiose plans and goals, but I don't think they put any type of cross checks to see if they can do it all.
I think, Joe, that is the reality for a lot of folks, and so I think that's why today we're gonna talk about how to put a plan together and how to invest for retirement. And so we will get into investing specifically, but I guess even before you get into investing, it's like, well, how much do I need to save? What's my number? So we'll get into some ways of calculating what your number is. And then it's all about creating a savings plan. So how am I going to get to that number to make sure that I stay on track? And then once you have that number, or as you are saving, how should you invest? This is very important because a lot of people make a lot of mistakes when it comes to investing for retirement. And then finally, what about this? What about minimizing your taxes? Because a lot of investments are going to cause you taxes. And if you know a few simple strategies, you can end up paying a lot less taxes in retirement. And Joe, this is one of those shows that I think we're gonna combine a lot of strategies all in one, and so people can have a sense of how to get on track for retirement, and so that they can kind of live that dream that they want to live.
Right. I think it's just putting things in perspective, right? It's just take a look at, all right, well, what am I trying to accomplish first of all? And do I have a plan in place? And if you just follow the sequence of this show, I think you'll be better set for your overall retirement. If you're currently retired, that's fine. Maybe you got to rearrange some things and make you take a step back to figure out exactly what you need to do. So figuring out your number, how much money do you need? Do you have 20, 30 years? Or are you currently retired or maybe knocking on the door of retirement? That's the first step, is kind of figuring things out. What's the savings plan here, Al?
And I think number one is if you are about ready to retire, or maybe you just retired, how about this? Take a look at your final pay and then multiply that by 8 to 10 times. So what does that mean? Let's say you made $100,000 a year. Multiply that by 10, so you need about $1 million to create that similar lifestyle. And I will say, Joe, you know, when it comes to that, there's a lot more to it than these simple rules of thumb.
But I think it gets people there.
It gets you a start.
Right?
Anyway.
It's like, okay, well, here, I'm retiring tomorrow. I want to spend $150,000 and I have $200,000 saved. Right?
Yeah, it's not going to work.
You have a good year and a half, you're done, right? So you want to make sure that you know exactly how much money to get you in the same zip code, if you will, right?
Yeah,
I mean, it's a good rule of thumb to look at, all right, well, how much money should I have saved? And then you say, all right, well, am I on track, not on track? Do I need to work a little bit longer? Because later on in the show, if you're not anywhere near those numbers, there's a few tweaks that you can do to get you pretty close.
That's right. Now, if you have several years to work, then you want to take a look at this other metric here, which is fairly simple. Save 15% of your take-home pay every year. If you will do this, let's say for 30 years, I know that's a long time and it's a lot of discipline, but we're talking about saving about 15%. So in this example, $100,000 of gross income, your take-home pay after taxes is $75,000 annual savings. So you want to save about 15% or $11,250. And look at this. If you invest that at 7% over 30 years, it's over $1 million. And that's really, you know, we talk about becoming millionaires sometimes. It's actually not that difficult by a little bit of disciplined savings.
Not that difficult.
But
everyone would be a millionaire.
If you start early.
Yeah, all you have to do is start when you're a baby. You'd save $11,000 a year and get a 14% rate of return. But some of these numbers, it's daunting. People get freaked out. It's like, you know what, I don't have anywhere near this, so what do I do? Here's, you know, no one likes to budget, right?
Sure.
So here's a real simple way to do this. Look at it like this. Pay yourself first. All right, pay yourself first. Take a look at your paycheck and say, you know what, I want to save 1%, 5%, 10%, 15% of my overall paycheck. You start there. Then pay everyone else after that. The budget, it just comes into form at that point. Here's what most people do, all right? They pay their bills, all right? They you know, and they do all this other stuff, and then they say, well, I don't have any money to save. If you save first, and then have everything else, it will fall into play. You start slow, you start small, and then you can build yourself up. And the next thing you know, you have some money. You're gonna get motivated, and the more motivation, the more confidence that you're gonna have, you're gonna save more money, and you're gonna be able to live the retirement of your dreams. All right, we're just getting started. When we get back, we got a full segment. We're gonna talk about investing, we're gonna talk about taxes, and so much more. So don't go anywhere. The show's called Your Money or Wealth. Good morning, everyone. Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson, Big Al, hanging out, talking about the golden rules of investing to get you to retirement. And then once you are in retirement, there's some key steps that you want to make sure that you follow. We're going to get into a bunch of them right now. But before we do that, let's go to the true-false question. Let's see how you did.
I can give my kids $14,000 a year tax-free. And that answer is true. You can give your kids $14,000 a year tax-free. In fact, if you're married, husband can give a child $14,000 and spouse, wife can give child $14,000. And the thing about this is you can give more than this, then you just have to file a gift tax return. A lot of people think they have to pay gift taxes. Actually, that's not necessarily true. What happens is you file this return, and what that does is it reduces the amount that your kids will receive tax-free when you pass away. But don't worry, that exclusion is over $5.4 million. So anyway, it's a true that you can give $14,000 per year.
It could be. Well, it depends on what tax you're talking about, Clopine. So let's say if I give my kid $14,000 worth of stock,
True.
and I paid $1,000 for it, they sell the stock, they have to pay capital gains tax on that $13,000. So when you give, you want to make sure that you give cash. If you give an appreciated asset, then the giftor is going to have to pay tax. The basis carries along with it. So
very true, Joe. So you want to go down deep.
I'm just here to keep you honest there, my friend. I'm here to keep you honest.
Here's the thing. If you may want to give an appreciated security because maybe your child's in a lower tax bracket.
Wow.
But if they're under 17, the kiddie tax rules. You want to go this deep, huh?
No, we're good.
Anyway, here's what I want to do. I want to have one of our clients ask you a question, and you got 60 seconds to answer it. Let's see how you do.
All right.
Hey Joe, my question is about with the volatility of the market, much of the investment strategies are based on historical performance. Does that really still apply in today's world?
I got 60 seconds to answer this. All right, so volatility of the market. The markets have always been volatile, so that has not changed. But the way you invest should have changed from maybe 20 years ago. The answer, in my opinion, is yes. Because if you're buying individual stocks and trying to time markets, which a lot of traditional investors did, right, you might have found a way to outpace or have an outperformance of the overall market. But today, with billions of dollars trading hands, it's very difficult to outguess the overall market. So I think your investment strategy needs to change, to take a look at, hey, maybe I don't buy individual stocks, I buy a basket of stocks, right? Maybe I look at different factors of the markets to give me a higher expected rate of return than trying to guess in time and when to get in and out of the overall markets and what stock to pick. So I think the philosophy needs to change, but I think volatility is always going to be in the market. It will always be in the market. It was volatile when your grandfather invested. It'll be volatile when your grandkids invest. So,
You didn't make it.
Well,
did
I could spend an hour on that question. The volatility of the overall markets. I mean, we could get into volatility.
Well,
we could get into investment strategies. We can do all sorts of things.
There was a lot packed into that 60 seconds, and I'm not sure I even understood it. But anyway, we're going to dive in a little bit deeper here in investment shortly. But Joe, I think before we even do that, we talked last segment about what's your number and how to start saving and some plans there. But let's kind of put some pencil to paper. Let's talk about accumulation. And first of all, the first concept is, and this is probably not new to you, the sooner you save, the better. So here's an example of a 30-year-old that's going to work 35 years to age 65. They save $10,000 a year at 7%, and it's a $1.4 million ended up saved by the time they retire. At age 40, same things, only now it's 25 years, $630,000. Age 50, it's $250,000. So it's true that the sooner that you start, the better. But Joe, the problem is a lot of people are in their 50s and they haven't really saved very much. So, and I think we talk about budgets, we talk about saving, and it's all about then, I guess I'm so far behind I don't even know where to start, right?
Right, and it's just a few tweaks, all right? So let's say if you're in your 50s or 60s and you don't feel that you're prepared, right? Do not feel hopeless and say, you know what, I'm not gonna save because I won't be able to accumulate anyway. No, I mean, you have to take a look at a lot of different factors. A, do you have money right now that you're saving? Okay, so you take a look, can you increase that at all? Then you take a look at your retirement date. Everyone does not have to retire at age 60 or 62. You can push this thing out to age 70. That would probably be ideal for most people, right? So then you take a look at, all right, well, if I make a couple of tweaks here, Alan, what could be the bottom line here, right?
Yeah.
So
let's go through an example. So if you are behind and if you're in your 50s, how about this? If you're age 50 or even 55, here's a couple thoughts. So if you don't have anything saved, you better start to get serious, start cutting your spending, because you want to maximize your 401k, which if you have one, it's $2,000 per month, so that's $24,000 for the year. It's common for your employer to match about 4%. And then if you're thinking of retiring at 62 or 65, how about pushing it out to age 67 at least, if not 70? So in this example, pushing it out to 67, a 7% rate of return, and a 50-year-old can still accumulate $865,000 starting right now, right today. And a 55-year-old, it's $500,000. So it's not hopeless. And the thing is, the stats tell us that the average 401k balance is less than $100,000. If you can save $500,000, you're well ahead of most everybody else.
Right, and then you just take a look at, all right, if you can accumulate 200,000, 300, 400, 500,000. If you're in your 50s or 60s, you've got plenty of time. If you're 60, retire at age 70, that's 10 years. That is a ton of time. If you're in your 60s, you're probably at your peak earning years where you can, all right, well, here now I'm making the most that I've ever made. Is there a way that I can squeeze a couple of extra dollars out, put that into my 401k plan? It's pre-tax, so it's not all going to you, right? The government is helping you out save here. So then you look at, all right, well, what order do I save? This is a big, big question that we get. It's like, okay, well, Joe, I want to save. How do I save? Here's what you do. Here's Joe Anderson's rules of saving, right? I don't know why it doesn't say that, but it says order of saving.
I think I had something to do that.
Yeah,
too.
I got it. All right. So you want to save into your 401k plan, if you have a 401k plan, to the match. Then you want to switch your savings, all right? So it depends on, of course, how much that you want to save. But go to the 401k plan to the match. Then switch to the Roth IRA. $5,500 is the maximum that you can put into a Roth IRA if you're under 50. If you're over 50, they give you a $1,000 catch-up, $6,500. If you still want to save, go back to the 401k plan. Max that thing out. The maximum, if you're over 50, is $24,000. If you're under 50, it's $18,000. Then if you still have cash, then you start a brokerage account, a personal savings account. And I'm going to add a fifth thing to this, because once you save into the 401k plan, right? Once you save into the Roth IRA, then you go back and max out that 401k plan. That's going to reduce your taxable income. right? And then you look at, all right, well, how do I maximize more tax-free dollars? You might then want to look at converting some of the money to a Roth. And using that extra capital, instead of putting it into a brokerage account, you might use that to pay the additional tax to get more money into a tax-free environment. Having that much money into a tax-free environment, I'm telling you, you'll never ever pay tax on those dollars as they grow ever again. So it's key. So you want to make sure that you maximize both plans, but have a strategy in place to figure out, what am I going to do here with the money that I'm trying to save?
No question. Now let's get into different types of investments. So this is basic, right? Stocks, bonds, natural resources, real estate. I think a lot of people know that these investments are available. But then it's all about, well, how do you save in these? And Ty, if you'll put up the next slide, we're going to talk very quickly about how to invest in stocks and bonds and real estate and commodities. And number one is you can invest in individual positions. Or you can invest in retail mutual funds, index funds, ETFs, or evidence-based institutional funds. Individual positions would not be our recommendation, particularly if you're close to retirement, because it's a lot of risk in an individual security. Retail mutual funds tend to be a little bit more expensive than index funds, so we prefer those index funds and ETFs, and there's some institutional-based funds that if you have access to a planner, you can get into them. They've got a lot of advantages too. But just know there are different ways to invest so that you get exposure to stocks, bonds, real estate, and commodities.
Right. I mean, I think down to the simple level, it's like, okay, yes, you do want stocks, you do want bonds, you probably want to have some commodity exposure, some real estate, and then the next layer there is like, all right, well, do I want to buy an individual stock? Well, no, probably not. You want a little bit more diversification.
Right.
So there's different ways to do that. So you can look at an index fund, an ETF, a retail mutual fund, whatever that you have available to you, right? That's going to give you a little bit more diversification. And then you look at, all right, now that I understand that, what's the strategy here? Well, first, then you want to have an investment strategy that's across the globe, right? You want to diversify globally. Here's a really difficult thing for a lot of people to do is avoid market timing. It's like when the markets are good, that we feel confident, so then that's when we pour a lot of money into the overall markets. But when the market turns south, that's where we get fearful. That's where we start pulling money out of the market. It's very difficult to time it perfectly. We're like, oh, the market's going to go to zero, so let's get out. No, it's very challenging. I'm not saying it's impossible. I think some people can do it, but I would say most people have a very difficult time doing it, and they end up losing a lot more money than the strategy that they were thinking about was going to help them. So avoid market timing, I think, with all costs.
Yeah, and then we talked about go for low-cost funds, and then also rebalance to target. And so that just simply means when you have an asset class, let's say large company stocks, and you want that to be 10% of your portfolio, if it goes up to 12, 13, 14%, you want to be selling some of that. Take some of your profits off the table to get back down to 10%. Now, if it goes down to 8%, 7% of your overall portfolio, be buying some. That's what a target means. So you're actually rebalancing to targets. Don't just look at this once a year, be looking at it constantly, because you never know when this thing's going to be out of balance.
Great point, because then it gives you the discipline that you need. Because when things go down, you're actually buying more. When things go up, you're selling to get it right in the exact target for your risk parameter. So it's very, very key to do that. And then that's the best way, I guess, to market time.
Yeah,
right?
In a sense, yeah.
In a sense, is that you're doing things appropriately for your overall risk. All right, we got to take a break. When we get back, we're going to talk about taxes. And then we're going to flip the show to you and answer your email questions. We got a bunch of good ones today, so you don't want to miss this. The show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back. Good morning. Show's called Your Money or Wealth. Joe Anderson, Big Al Clopine hanging out, talking about the golden rules of investing for retirement. We're going to wrap it up here, talking about your questions. But before we do that, let's go to the true false. Let's see what we got here.
If I continue working into my 70s, I don't have to take the required minimum distributions. And I'll start with this one, Joe. There is a rule that if you're working into your 70s, past 70 and a half, which is when you normally have to take that required distribution, if you're in a qualified plan like a 401k and you're contributing to the plan, you don't have to take required distributions out of that plan. Okay, but you do have to take required distributions out of your IRA or other older plans that are not currently active. But there is an exception, and that is if you're more than a 5% owner of the company, you still have to take the required distribution.
Oh, I was going to get you deep on that one, buddy.
You're going to go deep on that one,
good.
weren't you?
Yeah, so I mean, here's the deal. If you're still working in your 70s, right, people are like, oh, I got to take this required distribution. No, if you work for a large company, take your plans and put them all into the 401k plan. That avoids the RMD entirely. But then when you do retire, right, then that's when you have to take the required distribution. It's due April 1st the following year after you retire. If you don't take it the year retired, then you have to take two the following year. Know that if you're going to work until your 80s, that distribution might be quite large, so you probably want to get some of the money out of the plan prior to that anyway. So a lot of different things when it comes to required distributions and retirement plans altogether, because they're infested with tax. And speaking of tax, you have to take a look at where you're saving your money when it comes to your overall retirement. Well, there's tax-free money, Roth IRAs. There's tax-deferred money, such as the 401ks and taxable money, which would be a brokerage account. You want to be diversified in your strategy. I would say most of you that are watching this program, most of your money is in a tax-deferred account, a 401k, IRA, 403b. Just know every last dollar that comes out of there is going to be taxed at the highest of rates. So when you come up with a strategy, you want to make sure that you're diversified when it comes to your taxes. Big Al, you got anything else to say about that?
And Joe, that's true. And if you do have most of your assets in a deferred account, then start looking at trying to get some converted. You can take IRA money, you can take 401k money, you can convert it to a Roth IRA so that all future growth in income and principal is tax-free for you, your spouse, your kids, whoever inherits it. However, you have to pay the taxes on the conversion. So even though you're allowed to convert anything you want to, regardless of your age, income level, whether you're working or not, you shouldn't necessarily convert at all because you'll be in too high of a tax bracket. So it would be sensible to come up with a strategy to maybe convert a little bit each year to stay in lower tax brackets. So by the time you get to retirement, you've got more tax diversification, Joe.
Yeah, there's a lot of things to look at here. You have to take a look at your tax bracket, your kid's tax bracket, right? So let's say you don't have a lot of money in there. Your required distributions aren't going to hurt you. You maybe continue to defer it, have your kids inherit it because they might be in a lower tax bracket. Maybe they're in a giant tax bracket, so converting, you pay the tax, they get a tax-free. A lot of different planning when it comes to overall wealth transfer, but I think what we're talking about today, more importantly, is taking a look at giving you the rules that you need to have a successful retirement. All right, so let's turn the show to you. Got a couple good emails today, bud. Let's check them out.
We do. The first one is from Anonymous. I am delaying taking my Social Security to receive the added benefit, but I don't know if the extra benefits are compounded monthly or yearly. I want to claim my benefits starting in 2018. Can I start taking them in January? Or do I have to wait until my birthday in April? Wow, Anonymous, good questions. Let's see if Joe, the guru, can answer this question.
No, I defer. No idea. So there's 2 points here. You're delaying your Social Security benefits. First of all, we need to know information. Are you delaying it from 62 to full retirement age? Or are you delaying it from full retirement age to age 70? So let me answer the question, because this is what I think, is that you're delaying it from full retirement age, let's say 66 to age 70. Because what you receive from Social Security is called a delayed retirement credit of 8%. That 8% credit is calculated monthly. So you get 1/12 of the 8% per month that you wait. Okay? So if I'm looking at waiting, all right, so then you don't have to wait the full year and they calculate the full 8%. No, each month that you wait, you would receive 1/12 of that 8% credit. So let's go to another email question.
Thomas from Santa Monica. I want to help my grandkids with their college tuition, about $30,000. Is there any exception that allows me to use my IRA funds without having to pay taxes or a penalty? Well, first of all, there's no exception for avoiding taxes. You're always going to pay taxes when you pull money out of your IRA. Now, if you're under 59 and a half, which I'm assuming as a grandparent for a grandchild, you're probably over 59 and a half, but let's say you're under 59 and a half.
How would that be possible?
You could be 15 years old and have a kid.
Come on. God.
And your kid be
No.
15 years old.
No.
And then 18-year-old.
No.
It's possible.
No, it's not.
Possible. Yeah.
Okay, well, maybe. Okay. Whatever.
Well, let me just answer it. So here's the answer. You can use about $10,000 out of your IRA. You'll still pay taxes, but you can avoid penalties as long as it's for college.
I suppose it depends on if it's a Roth IRA or traditional IRA. If it's a Roth IRA over 59.5, it would be tax-free.
True.
But if it's prior, so whatever. No way that my grandchild, $30,000, she's under 59.5. Not
unlikely.
Not going to happen. Not going to happen. All right, that's it for us this morning. Hopefully you enjoyed the show. We had a wonderful time doing it. Join us next week because we are going to have something phenomenal. I have no idea what we're going to talk about, but you're going to love it. Have a wonderful weekend, everyone.